This is a video again on capital leases from the lessee standpoint, and this will be the amortization of our lease obligation. And the best way to do this is through an example. So let's go on to the next slide. And what I've done here is I've recreated an example from a previous video where we talk about Xenex Corporation. It entered into a 3-year lease for a machine, and the cost of the lease is $100,000 a year for those 3 years. The machine had an economic life of 4 years, and the fair value retail price of the machine was $250,000. The company's incremental borrowing cost is 12%, and the implicit interest rate on the lease is 10%. In addition, Xenex was required to guarantee that the machine would be sold or could be sold for $50,000 at the end of the term of the lease. And again, if you will remember, we went through present value calculations that included two components in this case. We had to calculate the present value of our $100,000 minimum rental payments, which was the present value of an annuity at 10%, and that comes out to $248,690. We also had to calculate the value of the $50,000 guaranteed residual value, and that value would have been paid at the end of the 3rd year as a final lease payment, and that would be discounted at the present value of $1 at 10%. So that amount would be $37,565. That means the present value of our lease payments would be a total of $286,255. Now, when we calculate that, what we do then is calculate, okay, we treat this as it's the purchase of an asset, in this case for $286,255. And we also treat the credit portion as a lease liability. That's the amount of money we owe on this purchase of asset, and it's $286,255. Now, over the life of the leased property, we're going to be depreciating that leased property over its economic useful life. At the same time, then, we're going to have to amortize the lease liability. So we're going to talk about how we go about amortizing that lease liability for the lessee at this point. We do that through what we call basically the interest rate method, utilizing this type of amortization table. And I have my year, I have my beginning lease obligation, my effective or my interest rate that I'm going to use, the lower of the 12% or 10%, equals an interest expense. From that, I'm going to subtract out my payment on my lease, and anything that's not interest expense is going to be retreated as a reduction of my lease obligation, which will then result in my ending lease obligation. So let's take a look at year number 1. Year number 1, my beginning lease obligation, lease liability, was $286,255. I multiply that times 10% my interest rate, and my interest expense comes out to $28,626. I subtract my cash payment on my lease payment out of $100,000, and what is not absorbed in my interest is going to result in a reduction of my lease obligation in this case, which would be $71,374. So I subtract that from my beginning lease obligation. My ending lease obligation ends up at $214,881. And if we're going to make the journal entry for that, I would have my credit to cash from my rental payment. I would have a debit to interest expense for the $28,626 and a debit to lease payable, reducing my my lease liability by $71,374. Now, if you trace these back, you can see the ending lease obligation at the end of year 1 on my balance sheet now would have a balance of $214,881, and on my income statement, my interest expense would be $28,626. Okay, now let's take a look at the amortization of the lease obligation for year number 2. Year number 2, our beginning lease obligation was the $214,881, which was the ending obligation from year 1. The effective interest rate is 10%. times at 214.81 means our interest expense is going to be $21,488. We're making our annual cash payment of $100,000. So $21,488 is considered interest. So we have a reduction of our lease obligation then, the net of the two, which would be $78,512. So our ending lease obligation is $136,369, and we can see our year 2 journal entry where we debit interest expense for the $21,488. We debit our lease payable for the amortization of our lease obligation of $78,512, and our credit is to cash for $100,000. If we take a look at our balance sheet, our lease payable now has been reduced to $136,369, and we recorded $21,488 of interest expense. Now we can move on to year number 3. And in year number 3, again, our ending lease obligation from year 2 is our beginning lease obligation in year 3 times our 10% rate, means that our interest expense is $13,637. Again, if we subtract out our cash payment on the lease, $13,637 will go to interest, and the remainder will go to a reduction of our lease obligation, which will be $86,363, and that's going to leave an ending lease obligation of $5,006. In theory, it should actually leave an ending lease obligation of $50,000, but due to rounding issues in the amortization table, it's $6 off. If we take a look at our journal entry for year number 3, we're going to debit our interest expense for $13,637. We're going to debit, again, amortize our lease for $86,363 and credit cash for $100,000. So in year 3, our balance sheet should show liabilities. In this case, I show $50,006. It should be $50,000. We just talked about that. And that represents my, guaranteed residual, basically guaranteed payment at the end of the guaranteed residual value at the end of the lease. And my income statement for year number 3 would show interest expense of $13,637. So now, with that in mind, we've seen how we had amortize our lease obligation between over the life of the lease, and again, we'd make our annual rental payments, and we had split up the payment between our interest expense and the amortization of our lease payable based upon the interest rate method in our amortization table. So let's go ahead and start off with multiple choice question number 1. A 20-year capital lease was entered into at the end of year number 10. At the end of year number 10, there are 20 equal minimum annual lease payments due at the end of each year. The first minimum annual lease payment was paid at the end of year 10, and there will be 19 more annual payments subsequently. Which of the following will be included on the year 10 year-end financial statement? So I do want to clarify this a little. It says there are 20 equal minimum annual interest payments due at the end of each year. It means there's one payment at the end of each year for 20 years. So I apologize for that error in the wording. So which of the following will be included on the year 10 year-end financial statements? Again, we're given 4 choices in our multiple choice question. Go ahead and stop the video, and when you're ready to have the answer, go ahead and restart the video. Okay, number 1. The question again for number 1, which of the following will be included on the year 10 year-end financial statements? Now, this particular question is a very tricky question because it has a couple of different concepts in it. And the answer in this case is actually C, lease liability only. And the reason for that is, remember that interest expense is associated with the passage of time. Now in this above example, the first payment was made at the same time the liability was incurred. It was almost like a down payment per the lease. Not really a down payment, but literally it had the same effect. So there was no passage of time. Therefore, if there is no passage of time, there could be no interest expense in this case. So this is a pretty sophisticated question. So anyhow, that's the answer to question number 1. Let's try question number 2. And the good news about question number 2, it's a little more conventional than question number 1. On January the 1st, year 4, a company entered into a 10-year lease for equipment. Annual lease payments of $10,000 are payable at the end of each year. The lessee knows that the lessor expects a 10% rate of return on the lease, and that gives me, that's basically an implicit interest rate. The lessee had a 12% incremental borrowing rate. The equipment is to have an estimated useful life of 10 years. In addition, a third party has guaranteed to pay the lessor a residual value, if any, at the end of the lease. So we're given some present value information, and the question is, in the lease's October 31st, year 4 balance sheet, the principal amount of the lease obligation was, remember, we entered into the lease obligation on January the 1st, year 4, and the lease obligation we're trying to measure is at October 31st, year 4. And remember, we make our lease payments as annual payments. Those are all important things. So go ahead and stop the video, and when you're ready, restart the video and view the answers. Okay, number 2, the question again, in the lessee's October 31st balance sheet, the principal amount of the lease obligation was. Now, first of all, you need to think about the fact that we entered into the lease on January the 1st of year 4, and the first time we're going to make a payment on the lease will basically be at the end of the year of year 4, December 31st. So nothing has happened regarding the lease balance as of October 31st, year 4. So in this case, we need to calculate at least the present value, the minimum of lease payments, which are going to be our $10,000 times the present value of an annuity at 10% for 10 years, which will be $10,000 times 6.1146. So the present value of this particular annuity of $10,000 a year of 10 years is $61,446, which would be B, the answer to our question. Now also, we could possibly, because we are told that there is some form of residual value, or rather a guaranteed residual value. We're not told how much it is, but we are told that an independent party is guaranteed the residual value of the lease. So in this case, the residual, we wouldn't have to include that even if the amount was available, because a third party guaranteed the residual value. So that would be the answer to number 2. Let's try number 3. At the beginning of the year, a company entered into a 5-year asset lease with annual payments of $100,000 beginning at the end of the year. The company treated this lease as a capital lease, so we know it's a capital lease. The 5 lease payments have a present value of $379,000 at the first of the year based upon an interest rate of 10%. What amount should the lessee report as interest expense for the year ended? So again, stop your video. After you've come up with an answer, restart your video. Okay, the answer to number 3 again is, or rather the question is, what amount should the lessee report as interest expense for the year ended, for the period ended? In this case, it'll be D, $37,900. Remember, we made the payment at the end of the year, and we're asking basically what amount should the lessee report as interest expense for the year ended. So we take a look at year one, and we can set up our interest rate method amortization table. We know our beginning lease obligation was $379,000, and we know our effective interest rate is going to be 10% in this particular case. So our interest expense is going to be $37,900. And you can see I continue across the amortization table to show you there'd be the $100,000 cash payment and the reduction of the lease obligation, then the ending of the year lease obligation. So they could have asked any of these particular questions about what was the reduction of the lease obligation, or what was the ending of the year lease obligation, and utilizing this table you could have come up with the answers. Let's try number 4 now. In the long-term liability section of its balance sheet at the end of year 10, a company reported a capital lease obligation of $75,000. Lease payments of $9,000 were made in year 11. The lessee's incremental borrowing rate on the date of the lease was 11%, and the lessor's known implicit rate was 10%. In its year end of year 11 balance sheet, what amount should the lessee report as a capital lease obligation? So again, go ahead and stop your video, and when you're ready, restart it for the answer. Number 4, again, the question is what amount should the lessee report as a capital lease obligation? In other words, the remaining obligation after we've made our payment. And the answer in this case is B, $73,500. If we take a look at year 11, we can see we reported a capital lease obligation $75,000 at the end of year 10. So that becomes our beginning year lease obligation in year number 11. Our effective interest rate in this case was the lower of the two, either the incremental borrowing rate or the implicit interest rate. So it would be 10%. So it would be the beginning of the year lease obligation of $75,000 times 10%. That means our interest expense would be $7,500. We made $9,000 in rental payments. That means $7,500 was absorbed into interest, and then the remaining amount was a reduction of our lease obligation, which would have been a reduction of $1,500. So the $75,000 minus our $1,500 reduction of lease obligation means our end of year lease obligation would be $73,500. And with that, that is the end of our capital leases lessee amortization of lease obligation video. And the next suggested video is, again, our leases, capital leases, the lessee depreciation associated with capital leases. Thank you for your time.